Well, hey guys, I'm so glad you decided to join us for a follow-up from our No Regrets series and the day we talked about money. And specifically trying to give you some tools that will help you from a broad variety of life positions. And I asked my friend Rich Krafcik, who's part of our Midlothian campus here at PCC, to come. He runs an investment firm that he owns. And so it's probably safe to say, you might look at somebody who runs an investment firm and think, well, this guy, his whole life is about money. But I would push back on that. And I would say, Rich really cares about people. The more interactions I have with him, the more I realize he's really not in the money business. He's really in the people business. And this is one important aspect of people's lives. As I mentioned on that day in church, Jesus talked more about money than he did about heaven and hell combined. Not because it's more important, but simply because it infiltrates lots of areas in our lives. So, Rich, I just want to thank you for being with us today and offering your expertise. I want to start like this. One of the quotes that I gave was from Dave Ramsey, and he said, when it comes to money management, it's 20% knowledge and 80% behavior. Is that something that you would agree with in your experience and what you do helping people?
Absolutely. So, Brian, thank you for having me, and I appreciate that intro. Very nice. It is. So, the decisions we make are going to have a profound impact on the financial decisions in our future, whether it's a decision on what to buy, when to buy it, where to finance the purchase from, how to just go about your month-to-month living. Behavior is the hugest impact.
Here's what's interesting for me is I did this when we talked before today. In the message I was talking about, the first step is we have to stop the bleeding. We have to add no more debt. Mm-hmm. And when we talked as we were preparing for today, you mentioned something that I found fascinating and have never thought about before. And I'm just going to tee it up for you. I've often said in our lives what we do is we trade our time for a paycheck. That's what a job is. I agree to give you my time. You agree to give me money for my time. You're buying my time so that I can then apply those funds and do other life with it. So you're literally buying a piece of my life. And that's where I've always stopped. I think it's a good word picture. It makes sense. But you added something to it about going into debt and what that does with future time. I'd never heard anything like that. Would you share that with us?
Sure, absolutely. So 2 ways to really think about debt. And first, it starts with what is money, right? Money is this resource we have that oftentimes we trade our time and our talent to attain. For most of us, we're trading time and talent to get money on a weekly, monthly basis. So when we choose to spend more money and make more money flow out than what's been coming in, we're making a decision to incur debt. From that point forward, we're committing our future self to having to repay that debt. So we're really trading our future time to enjoy something today. Mm-hmm. And I talk to people about trying to make decisions so that we're doing favors for our future self and not setting ourselves up in a deficit.
Right. And it makes total sense. I had never considered or thought about it in that way. If we're trading time for money, we're not just trading, when we go into debt, we're not trading today's time. We're getting a short-term, benefit, a euphoria for whatever it is we bought, but we're really leveraging future time in order to have this thing today. I just found that to be fascinating. Let's talk about, so I made this statement, I do kind of stand by it, but I made this statement that we got to stop the bleeding. That means no more debt. But there are lots of different kinds of debt. And there might be a situation where people, in addition to buying a house, most of us can't pay cash for a house. Talk about some other kinds of debt that people might just have to do.
Yeah, absolutely. So first, there is good debt and bad debt, and I'll talk on that in a moment.
Okay.
But before that, when we think about the type of debt that we're mostly talking about here, we're talking about consumer debt. So the idea of consuming more than we earn and putting ourselves further into debt in the process. There are people out there that have real medical issues, they have expensive medications, they have medical procedures, and the reality is, no matter how hard and how disciplined they are on a monthly basis, they just can't get ahead. Mm-hmm. So a lot of what we're going to cover today is not at all targeting or maybe even not fully relevant to those people. Mm-hmm. There are some things they can do to try and dig out of that hole of medical debt, but I truly feel for them, and you know, that's just a different situation. I can add with just good and bad debt.
Yeah, well, I'd love to hear from. Talk about that. Talk about good and debt.
So beyond just medical debt, and there's other ways that you might go into debt to help a family member through an important situation. So we don't want to treat all debt similarly, but there are some times, you mentioned a mortgage, where it could be prudent and actually very financially responsible to take on some debt. If we want a home for our family and we don't have the cash to buy a home in full, then it clearly would make sense to borrow money at a reasonable rate, have a home, raise our family in it, and hopefully be more economically productive over time, repay that, build us some equity in the process.
Right. So because the assumption is that real estate is going to appreciate in value, so it might even make financial sense to buy this thing and pay interest on it because the acceleration of the value of the home might exceed, we hope, and it often does exceed the interest rate that we're paying. Is that accurate?
Absolutely.
Okay.
And then there's when you think about the decision of rent versus buy, if we're renting, then the money flows out on a perpetual basis.
100%.
Right. So when we own the home, now it's not that every dollar that goes to that home payment doesn't exactly accrue to us as homeowners.
No.
We all know that.
That's right.
So you still have your taxes, you have your insurance, you have the costs of maintaining the home. You have some costs. You have interest costs to the bank for borrowing the money. But a lot of times that makes sense. Very different than incurring credit card debt, which can be found from 12% up to sometimes 30%.
Oh, yeah.
That's just a whole, and that's when the church and Dave Ramsey speak about debt, a lot of times they're speaking on that type of consumer debt.
And just so you know, I didn't prep every question. We haven't rehearsed this, so I'm going to ask Rich some questions that may not be that we haven't talked about ahead of time. Would you talk about the difference between? Do you encourage people to do shorter term, like forced discipline? So I was in a season where I felt like. And I really want you to evaluate this. You can do this right in front of everybody.
Sure.
Tell me if I'm an idiot.
And that's just fire what you have on your mind.
So
and we'll
for
go through
me,
this.
the last time I lived in my home a long time, I got it down to where it was a reasonable balance. Interest rates had dropped ridiculously low. Those days are gone. We all know those days are gone. But I felt like I was not disciplined enough to take a 30-year mortgage and pay it like a 15-year mortgage. So I got a 15-year mortgage. And for me, it was forced discipline. I also got a lower interest rate. How do you feel about that?
So it's interesting.
It also locked up my capacity because then I didn't have an option not to pay.
That's
I
right.
had to pay it.
That's right. So I'll give you a couple from my own personal history.
Okay.
We haven't talked about this before.
Yeah? No.
So have several rental properties, and I also have financed each one of those on either 10 or 15-year mortgages. We've never had this conversation.
No.
I did it for the same reason. I didn't want to take a penny from those properties. I wanted to have that higher payment, and it does build in that forced discipline. I'll give you one more example. First home, coming out of undergrad, bought a home, and at that point, I had only a 5% down payment.
Wow.
So they were doing this was 2006,
Right.
7. You could get all different types.
You
of
could get all the
loan
money
structures.
you wanted.
It was just it was a different world.
It
right?
was.
So I did an 80% primary mortgage. I did a 15% secondary.
Oh my gosh.
And I put 5% down. 21 years old, first time owning a home. I had a stable paycheck, modest paycheck though, and went and did that. I committed to myself that I wasn't going to do any traveling or any kind of luxurious spending and purchasing until that 15%, that second note, was paid to zero. I can still remember the dollar amount. I won't throw it on camera, but it took a while, okay? It was a couple years, and I stayed very disciplined, and that discipline has certainly stayed with me. And I think with finances, if you have the right behavior, then it's going to accrue to your benefit over time, and you're going to make good decisions.
Yes.
So.
I've certainly been in seasons in my life, and when I was younger, I made a lot of really bad financial decisions. And once I got myself together, I realized I have to institute discipline either by force, like taking a shorter term mortgage with a higher payment, or some other way. So I've been able to build up some capacity now in my life over a long arc of time, like a 25-year time frame. I had a guy come to me recently who is kind of my age, and he said, I really want to do what you've been able to do. And I'm thinking, well, this took me 25 years. Like, I don't, how do you tell somebody to begin if they have not lived a disciplined life to this point? Like,
Sure.
where would you say, where do you start?
Sure. So thinking about how to first get out of that hole, right? It starts with a philosophy shift, for sure. And I've drawn a lot of parallels to discipline in other facets of life. So if you look at America, we're a consumerist type of country.
We are that.
We are like that in our finances and in our nutritional choices.
Yeah.
A lot
You're
of
getting
times.
personal now.
I know. I won't.
Okay.
That's right. So
All
you
right.
think about digging out of that hole. It's one of those holes. Like if you're in a meaningful crunch. So let's think about first of all what your overall monthly spend looks like, and the moment you incur that first debt, the very next month your budget looks slightly worse than it did the month before.
That's right.
Because now you have all the same expenses, plus you've borrowed some money and you have interest on that money due. And then every month you continue that pie chart, if you can visualize right now as you're listening to this, just a pie chart of what your expenses look like on a monthly basis, interest becomes a larger and larger slice.
Mm-hmm.
So the first thing is to make the decision that, hey, this is not for me, not anymore, and to start reducing that the piece of the pie that interest takes from your budget.
Should be getting smaller.
We've got to get that smaller.
Mm-hmm.
Now, long term, the goal is to get that working in the other direction, right? We want our money to be generating interest, generating dividends, giving us growth so that it actually is additive to the monthly budget, the quarterly budget. But when you're in a hole, it's truly understanding that it's not a quick fix. Like you mentioned, you've accrued some success, and over 25 years you got to a point. The same thing, if you're in a hole today, we're not going to fix that in a day, a week, a month. Oftentimes, it's not as long as people think. So we'll sit down with someone and say, let's organize everything here. Let's look at if you have a mortgage, if you have car loans, credit cards, let's get it all on the table. Let's look at the interest rate. Let's look at the minimum payments and come up with a disciplined strategy to pay those off. As soon as you start making a payment beyond the required minimum, you're now starting to take that sleeve that goes to interest and reducing
And
it.
every month, it literally gets smaller every month if you can reduce the debt load. Less money goes to interest.
Absolutely.
Yeah.
And, we have the snowball term used a lot,
Yeah.
but this is a process that truly does accelerate as you work through it. And the early gains in this process come slower than the later gains
Yep.
as a result. So
Yep.
what I tell people is let's keep an eye on some of maybe the carrot that dangles at the end of this process, because at the end of it, and if you're listening to this and you have some debts you're currently servicing, take a moment and add up what you're spending every month, and just know that at the end of this journey, that's how much you can actually be using to now pay your future self forward.
Right. So you talked about discipline, and I'm going to get to some fun stuff in a minute about actually starting to maybe move towards building wealth a little bit. But in terms of just hanging out for a minute, a little longer in the digging out phase, you talked about your own discipline. You said I was determined I was going to limit my life until I got that 15% paid off. My experience with folks is that people really load up on things that they think they need. I've done this too, so this is not judgment. But like we drive cars that are way beyond what is actually required. And we think, well, I just don't have any choice. I've got this $800 a month payment, which I find crazy that they will finance a car now for 72 or 84 months. I think that's nuts.
Absolutely.
When I was coming along, 60 months was your longest car loan. You couldn't get a car loan longer than that. Now you can finance the thing for 6, 7, 8 years. The car's done by the time you're paying it all. You're still paying for it. I have encouraged people to think differently about what you think you have to have. You don't sell that thing. Yes, you'll take a loss. Still sell it. Get something that you can pay cash for or have a much smaller payment. Do you coach people that way? Do you say the same thing or?
I do, and the car's one example. I see it with homes quite a bit too.
Is that right?
Think about what a starter home looked like 20 years ago.
Oh, yeah.
Compared to today.
Right.
So the square footage might be similar, but every finish now tends to be higher end.
Yeah.
Like when's the last time you've walked in and you see a brand new home? Probably has a granite kitchen countertop.
That's right.
It has nice flooring.
That's right.
It used to be different surfaces, and
That's
we
right.
knew there were price points to be made. It seems like everybody, and I understand everybody wants the best, but as a result, you can really squeeze your budget,
Yeah.
right? So
You don't have to
cars-
have the best today.
Right.
Right.
And it adds up. Cars, it could be clothing, all the different decision points, even what to eat.
Yes.
At the end of the day, if we can look at most of our meals as an opportunity for healthy nutrition and fuel,
Yes.
it's not that expensive to eat clean and healthy.
Right.
But it's when we want to have that tasty restaurant meal a few times a week, right?
Or eat in a hurry.
Or in a
So,
hurry.
we tend to not plan all that well. By the time I'm hungry, if that's the moment we're figuring out what we're going to have for dinner, it's too late. Like I'm just going to get a pizza, which by the way, pizza is ridiculously expensive. Everything's expensive now. So I want to ask you two questions that are related. One is I met with some young people as I was preparing for that that message about finances, I met with some young people, and they were asking me questions about how I got to where I am, because I made some strategic, smart choices with I took some risk, and they said, how do we do that? And because when I was coming along, I could go, get a job. There was a pathway to buy a home.
Yeah.
It seems like a lot of young people, young adults now, are looking at it and saying, based on average salary, there's no way I can ever afford to buy a place. It seems like everything's gotten out of kilter. What do you say to that person? Because they're saying, I would really like to have a home for my family. What do you
Sure.
say?
And I'm hearing this a lot.
Is
a
that
lot
right?
of times it's from either kids or grandkids of clients we're working with.
Okay.
And they'll ask, hey, will you spend a half hour or an hour with someone that's maybe been on the house hunt for the last couple of years? It's been a frustrating time
Yeah.
to be looking for homes.
Yep.
And I hear the term, it's like we were competing against 4 offers and we won the home. And I'll correct them and say, you didn't win the home, you purchased the home. And we want to get careful
That's right.
around using that, right? We don't want to feel like we're going to overpay to win. We want to make
Right.
smart decisions.
Right.
So a couple things. One is sometimes it takes patience in those situations, and I do think home affordability. Now there's no crystal ball on this table in front of
Right.
us, but at the end of the day, salary growth has to support home price growth, and the home price really has 2 components. You have the absolute cost, the purchase price we see, and then the cost to borrow that money, which for most buyers that are not cash buyers, that's a very relevant factor.
That is.
So you've had home prices really ballooning higher, particularly since 2020. Interest rates have now floated higher. Salaries have as well with some of the inflation adjustments, but they're not quite keeping
It
up.
didn't keep up.
So at some point, that's going to reset.
Yep.
There's this equilibrium point that the market will find its way there. Sometimes the market can move longer than we can be patient, but I'd say stay patient, stay true to your numbers, and look at your budget. So it's an individual decision in that rent versus buy. So if you're out there paying rent, the rent keeps going up. That's equally frustrating, right? And you want to get out of that equation, but do a good rent versus buy calculation. And that's
Okay.
something. If someone's watching this and they're not sure how to do it, that's something. As someone on my team or myself, I'd be happy to spend a few minutes and just run that, because the
Okay.
rent versus buy, there's more to it than just adding up 2 payments.
That's right.
There are the components of the mortgage. There are
Maintenance,
maintenance.
taxes, insurance, upkeep.
Right.
Yep.
And depending on your career, flexibility comes with renting. You don't retain that same flexibility when you go and buy a home.
That's right.
So there's pros and cons both ways.
Okay. I want to talk about the balance between when I was coming along, the philosophy was you work really hard, you get a second job if you need to get a second job, and that's how you make your way. And I did that, and the price was high. Today, when our family gets together, Susan, it's not uncommon for Susan to bring up something that happened when our daughter, our oldest, was a year and a half old. I was not home for any of that. I was almost never home for the first few years of my parenting tenure, because I worked all the time. And I thought that's what you were supposed to do. And it's part of how I got where I'm at today.
Yeah.
That's true. But I hear a lot of young people say, I'm not willing to pay that price. But they're also saying, is there something in between? Is there something in between killing yourself
Sure.
and just shrugging your shoulders and saying, well, I guess I'm never going to have anything?
Yeah,
What
for
would you
sure.
say to that person?
I've seen that evolution, and there's some value to that thought
Oh, for
process,
sure.
right? They look at maybe their parents' or grandparents' generation and say, well, they were with the same corporation for 30 or 40 years.
Right.
That company gave them a pension.
Right.
They had a 401k, and the retirement picture was largely solved. If
Yep.
you stayed with a company for 30, 40 years,
That's right.
they took care of you. A lot of times today, you're moving company to company.
Right.
There is very few pensions. There are some government pensions, some utility companies. There are some exceptions, but many companies have done away with their pensions.
That's right.
So you have to figure it out for yourself. So in terms of trying to find that balance between life and financial success, there's a lot of room in between. I've been impressed with the way the next generation has kind of evolved to the freelance work, ways to earn money that doesn't require just a full-time 9-to-5
Right.
role. And some of those fit in addition to a 9-to-5.
Right.
So if you're trying to get ahead, you either have to earn more for every unit of time you're willing to commit,
Right.
or commit more time.
Right.
Right. At the end of
It's
the
the
day,
only way. That
That's
really
it.
it comes down to that.
So you talked about not being home as much. You were probably doing both, increasing the value of your time and committing quite a bit of time.
Both of them.
I've been there myself. I still think the formula it's the same, right? It needs
right.
to be done.
That's right. Well, let's talk about for just a minute about the person that says, "Hey, I appreciate all this. It's good for my kids, but I don't have any consumer debt. Maybe I got a little mortgage or not. And I've gotten past that point in my life, and I've dug out. I live within my means, but I don't really have a plan for the future. And I'd really like to, how do I get involved with something that helps my money start working for me to start thinking smartly? What do? They just come see somebody like you and you tell them what to do, or how does that work?
Sure. So there's a lot of ways. Some people enjoy doing this themselves. What I noticed, so over 20 years ago, I looked at the financial advising space, and I saw people that had great people skills. They were really good at gathering assets. They didn't always spend a ton of time on the managing. And then I saw that the planning process often was very product driven. So in my company in particular, I took the educated bet that there was a need out there for true institutional quality portfolio management coupled with just consultative advice. Hearing people where they are, giving them the advice they need, not trying to convert that to making someone a client or making a sale, right?
Okay.
So in terms of what they need, what they can do, if they need some advice, there are a lot of good places to get just advice. Some of it's available on the internet. Some of it you can schedule. You can certainly meet with me or someone like me. But if they get to product real quick, maybe I don't want to pick up my industry too hard in this setting, but
I got you.
I do in other settings, no doubt. And I think you should be, like, hey, let's pump the brakes on talking products and solutions. Let's do some true planning.
Right.
So in terms of what can they do, something I talk to our clients about is having I call it priority of savings. So enter every year, and we do this in my household, so if my wife gets a look at this video, this is going to sound familiar. I make sure, by the way, that in my house, just because I bring some expertise, I try and make sure that both partners, so in this case my wife, is along for the journey. And I found with a lot of couples, just to take a quick side note, sometimes one partner will trust the other to kind of take the lead, like we do in many areas.
Sure.
But this is something that you want to have some overlap. You want to be sailing together on this mission.
For sure.
If one of the two tends to take the lead, at least once a year, I'd say come together, set some priorities, and then throughout the year, remind yourself why it's important. So here's a couple. So have an order of savings or priority of savings. If you have one excess dollar, or 100 excess, or 10,000, 100,000, whatever that number is, you should know the first thing I'm going to do with my money is this, then that, and then move through. It's a series of steps.
Okay.
So for many people, that first baseline might be establishing an emergency fund.
Okay.
Might be putting something away on a monthly basis for retirement.
Okay.
I found that most people want to feel like they're meeting their basic needs and still be putting something away so that they feel like they're getting ahead over time. So that's where you set up that monthly trickle. And start somewhere. We did a talk prior on another topic where I had said just start to move the needle. If you recall that conversation,
Yes.
It's the same thing with retirement. Where if you're currently putting zero in, don't aim for 1,000 or 10,000 a month. Start with $50 a month, $100 a month,
anything,
and then you'll notice there's a positive spiral that starts. It gets exciting to see this grow, and 50 becomes 100, becomes 200. So just start somewhere. That order of savings is key. We have some good material on it, but it does get to be unique to someone's situation. How secure is their job? What do their needs look like? And that dictates how much needs to go to the emergency fund, how much can go to retirement. How far they are from retirement's a pretty big factor in that decision too.
And whether or not their income fluctuates. Right?
For sure.
Whether it's steady or fluctuating, if it's seasonal, when times are good, you better sock a bunch away.
For sure.
Because
we have a great tool. Since you mentioned it, I'll spend maybe 30, 60 seconds on it. So for people that have a very stable income stream, it's easy to set a monthly figure.
Sure.
What we've done for people who have a lot of fluctuation is set a floor and a ceiling. So we tell them, and I'm just going to pick some numbers to illustrate the concept, but let's say we want to hold at least 20,000 in savings. We then tell them, well, the ceiling here should be 35,000.
Okay.
And when it gets above 35, take that 15, right? 35 minus 20, take that 15 and go do something more productive with that money.
Okay.
Right?
Because savings is low yield. You're not getting a lot of return.
So cash brings comfort, but that comfort comes at a price. Underperformance over time.
I got you.
Right? It's not going to keep up with inflation over time.
Right.
So that's a nice way, and we've seen whether it's commission-based, you own a business, a lot of us have fluctuating income. Set a floor where you say if you're below the floor, the dollars that come in need to go to replenishing that. When you get to that ceiling, that's an automatic trigger that you need to move that spread of money, and maybe that goes to an investment account whatever that next layer that you're trying to build is, it goes there. By having that defined, it takes one more decision process out of the equation.
That's awesome.
So,
yeah, that's really great. Well, there's a lot here, and there's a lot to learn about finances. And I just want to say, the role of our church is obviously to provide spiritual guidance, but also just to help people where they are, because money clearly has a spiritual component, and so this is helping people advance their lives, live their lives more in control, and the way that God wants us to live. And ultimately, when we have productive finances, it also allows us to be generous, which we've not talked about. And I said when I did this message, this was not a giving talk, but one is part and parcel to the other. You can't be generous if you're so strapped financially that you're wondering how you're going to feed your family next week. So I do think that this is really important to become financially healthy. Obviously, you believe that.
absolutely.
And we just want to offer any help that we can to folks. And I hope this has been helpful to you, and that you continue on the journey. It a little bit over time makes a big difference. So thanks for being here. Thank you, Rich, for being a part of this.
Absolutely. Thank you for having me.